Well, good afternoon. Good afternoon. Good afternoon. This is Harry Brown, and I'm so glad to be back with you this Sunday afternoon, August 15th, 2004, for another 1-hour money hour, and we will talk about your money, your savings, your investments, and give a little different approach to how you can handle your investments in a safe way and how you can even speculate more safely than perhaps you have in the past. And we invite you to ask your questions or make your comments or offer your suggestions. You can give me a call at 1-800-259-9231. That's 1-800-259-9231. You also, if you are a little shy about calling, can email me a question. The address is question@harrybrown.org. question@harrybrown.org, and Brown has an E on the end of it. Well, last week I gave you the 16 golden rules of financial safety that have stood me well for many, many years, and I must mention that during the broadcast I said I would tell you how you could get a copy of those rules, and then, guess what? I didn't tell you how to get a copy of those rules. So I'm going to tell you now before I forget. If you go to my website, harrybrown.org, you will see at the top of the home page radio links to articles and websites mentioned on the broadcast. And just click there and you will get to the radio links for the investment show. And there you will find a link to the article, The 16 Golden Rules of Financial Safety. That's on my website, harrybrown.org. And if you just get to the home page there, I'm sure you'll figure it out from there on. Well, one of those golden rules is that for the money that is precious to you, you should have a balanced and diversified portfolio that will see you through whatever the future might bring. And that's what I'd like to talk about today, how you can set up such a portfolio, because it really isn't difficult. And it really doesn't matter how much you have in the bank. It is possible to get that kind of diversification. But I think we need to first reiterate the fact that we live in an uncertain world. There are all kinds of people out there who know exactly what the future is going to bring. They know when the stock market's going to turn around. They know when gold's going to go up. They know when inflation's coming back. They know what the GDP is going to be for the next quarter. They know all the things about the future. But the fact is that such things are only guesses, and when somebody is right every once in a while, the person can hold that up for the rest of his career, dine out on it for the rest of his life. But in fact, the only reason we are aware of such instances where somebody actually predicted the future correctly is because it is so exceptional. The rule is that people say things all the time, and it's just talk. And by the time the prediction would have come true, we've already forgotten about the prediction because other people are making other predictions about the far-off, far-distant future. And because we are now focused on the future, we don't look at the present and ask ourselves how that matched up with the predictions of 6 months or a year ago. We live in an uncertain world. But fortunately, despite the fact that there is an infinite number of possibilities for the future, war and peace, civil unrest or law and order, inflation, deflation, prosperity, recession, all the different possibilities that exist for the future, fortunately, whatever is going to happen in the future will translate itself into one of 4 economic conditions that will exist in the United States. There are only 4 possible economic environments, and those 4 are all inclusive. That means that whatever happens, whether it has to do with politics or the economy or the military or whatever it may be, in one way or another, it will reflect itself in one of the 4 economic environments that are possible. Now, what are those economic environments? Well, number one, and the most obvious one, is prosperity. Prosperity is a period when business is good, unemployment is low, the stock market tends to go up, and interest rates are low, and things are just generally quite good. And during that period, there are investments that do quite well. The second economic environment is inflation. That's the period when the consumer price index is rising at a noticeable level. The consumer price index being the government's index of prices in general on consumer items, things you buy in the store, houses, and so on, cars, the whole works. And we think of inflation as being only when the consumer price index is rising at a noticeable level. In other words, when the inflation rate is 1%, 2%, or 3%, it really is fairly meaningless. That's almost the same as no inflation at all. But when inflation is rising at 5, 6, 8, 10, 12, 15%, then we're really into a completely different environment. And fortunately, there are investments that do well during inflation also. The third environment is recession. Recession is a period of what we think of as tight money, a period when business conditions are not that good, and when interest rates are rising, and unemployment is rising, and people don't have as much money as they expected to have. That's why we call it a period of tight money. What happens is the Federal Reserve slows down the rate of growth in the money. In other words, when money was growing at 6, 8% a year, the money that the Fed is shoveling into the economy through a complicated process, when the money was growing at 6 or 8% a year for a few years, then suddenly it slows down to 4 or 5%. This creates real problems. People may even have more money than they had last year, but they don't have as much money as they expected to have this year. And the result is that they pull back. They try to conserve on their spending, and they try to sell things to generate more cash to make up for the income that they had expected to have and don't have. The same thing is true for businesses. Sales don't increase as fast this year as they were expected to increase. They may be larger than they were last year, but not as large as they were expected to be. That's a period of recession or tight money. And the fourth possible economic environment is deflation, which is the exact opposite of inflation. Instead of consumer prices rising, consumer prices are falling. And this creates all kinds of problems because it was not expected. And again, people expected the money supply to increase, but instead the money supply is shrinking very rapidly. During a recession, the money supply just doesn't increase as fast as it was increasing before. During a deflation, the money supply is actually shrinking, and this is creating all kinds of problems for people who had expected a much larger income, much larger business figures, and so on. So those are the four economic environments: prosperity, inflation, recession, and deflation. And when we come back, we will talk about how we deal with these in order to be able to make sure that you're not hurt by them. Our phone number is 1-800-259-9231, and you can give me a call at 1-800-259-9231 or email me question@harrybrown.org. We will be back in just a couple of minutes.
Money Talk is brought to you by the Genesis Communications Network.
Welcome back. This is Harry Brown, and this is the Money Hour on Sunday afternoon. And we are talking today about the creation of a balanced portfolio that will protect you whatever may happen. And I want you to know that before the end of the show, I will explain how you can act on these suggestions with as little as $1,000 in savings, or as much as $18 bazillion, however much money you have. It doesn't really matter. But before we went to the break, I mentioned that there were 4 economic environments: prosperity, inflation, deflation, and recession. And those are all inclusive. There is no 5th or 6th or 7th economic environment. At any given time, the U.S. economy is in one of these 4 economic environments. Now, sometimes we don't know which of these environments it is in. Sorry, we're getting a little static on the line for some reason. At any given time, we may not know which of the 4 economic environments we're in because we may be in a transition from one to another. We may be coming out of a recession and going into prosperity, or we may be slipping out of prosperity into inflation or into a recession. But the fact that we don't know at a particular time which one of the environments we're in doesn't mean that we're not in one of them. We are somewhere at any given time. Now, it's very interesting that there are investments that profit from these environments. Prosperity, obviously, is good for stocks. It's also good for bonds, because during most of a period of prosperity, interest rates are falling. And there's a very simple rule about bonds, and that is that when interest rates are falling, bond prices go up. When interest rates are rising, bond prices go down. Now, this is not just because the market responds in a speculative way to changes in interest rates. No, it is because of a very definite link between interest rates and bonds. When interest rates fall, it means that any particular bond now that pays a higher interest rate than the new interest rate in the marketplace is now more valuable than a new bond that might have the new interest rate on it. And as a result, people in the marketplace will pay more for the bond that has the higher interest rate, and rather than buying the new one with the lower interest rate. So the point is that as interest rates fall during a period of prosperity, bonds do well. So stocks and bonds both tend to do well during a period of prosperity. Gold, on the other hand, doesn't do well. Cash is sort of neutral during prosperity, but we also think of it as a foregone opportunity, that it could have been better used by putting it in stocks or bonds. More static. This static in my throat this time. All right, moving on. During a period of inflation, stocks and bonds do poorly. The stocks do poorly because inflation disrupts American business. Bonds do poorly because interest rates tend to rise, and as I said, when interest rates rise, bond prices go down. Gold, however, does very well during a period of inflation, and cash does poorly because the cash becomes less valuable as consumer prices go up. I want to digress here for just a moment to talk about the relationship between gold and inflation. Many people think that it's just some kind of mystical thing, that if inflation starts to get more intense, then people will think gold will go up, and so they buy gold to take advantage of it, and their buying makes it a self-fulfilling prophecy, and gold does go up. But in fact, there's a more direct link between inflation and gold. The U.S. dollar is the world's #1 form of money. There are people all over the world who keep some dollars even though they don't live in the United States. They keep it to facilitate international transactions, as a hedge against their own currency, as a store of value, for many different reasons. And they turn to the dollar for that purpose because the dollar is a currency that goes far beyond anything that the euro or the Swiss franc or the Japanese yen or the British pound is. For one thing, the supply of dollars throughout the world is large enough that obtaining dollars does not push the price of the dollar up. You can get as many dollars as you want without affecting the price of dollars. Secondly, the dollar is recognized anywhere in the world, and so it serves very well as money in that sense. Now, if things are going along nicely, prosperity is in the U.S., or even a recession in the U.S., people are content overseas to hold some dollars. But when inflation seems to be threatening the future value of the dollar, those people get uneasy. And again, it's not when inflation in this country is 1 or 2 or 3%. When it gets to be 5 or 6 or 7 or 8 or 10%, that those people get very uneasy, and a lot of them will sell some or all of their dollars and replace the dollars with the second most popular form of money in the world. And the second most popular form of money is gold. Not the euro, not the Swiss franc, not the Japanese yen, not the British pound, but gold. Gold, of course, is easily divisible. Gold is available everywhere. Gold is recognized everywhere. Gold is a large package of value in a small physical size. So gold has all those wonderful attributes of money. And so people turn to gold, and that pushes the gold price upward. You get a full bull market in gold only when there is strong inflation in the U.S. You don't get it when a crisis breaks out like 9/11 or something else. You may get a bump up in gold as people expect gold to profit from that, but only a full-scale inflation in the United States can create a long-term bull market in gold, a bull market like we had in the 1970s. A crisis in the world is good for money. And during normal times, the money is the dollar. That means the crisis is good for the dollar. It pushes the dollar up against other currencies. When inflation is ravaging the dollar, then a crisis is good for money, which means it's good for gold. And gold goes up rather than the dollar. Now, coming back to where we were, inflation is good for gold, but it's not good for stocks, bonds, or cash. And as we proceed with this survey, we will move on to deflation and recession when we come back from this short break, and I'll give you the investments that do well and don't do well in those two categories, and then we'll show how we can use this information to create a balanced, diversified, safe portfolio. This is Harry Brown. We'll be back in just a couple of minutes.
Money Talk with Harry Brown on the Genesis Communications Radio Network.
Well, welcome back. This is Harry Brown, and that happy music means that we live in a good world, and a world in which you can take care of the money that you've earned and make sure that you don't lose it. We're talking about how to create a balanced, diversified, safe portfolio. And I have gone over the 4 economic environments that are possible, and then talked about the investments that do well and don't do well during prosperity and inflation. Deflation is the opposite of inflation. It's when consumer prices go down. And even though inflation is bad for stocks, deflation is also bad for stocks because companies do not have the capital, the sales, and the other things necessary to be profitable. So stocks do badly during a deflation. As we know, the stock market went down by 80% during the deflation of 1929 to 1933. Gold also does not do well during a deflation. Gold saw a rise upward in the 1930s, but only because the U.S. government changed the price of gold in a foolish attempt to try to stimulate the economy that way by a long, involved, complicated process I won't get into. But basically, deflation is not good for gold because gold profits from inflation. Cash is good during a period of deflation because obviously the cash can buy more than it could before. But it's not a big winner because there's no real leverage in cash. The one investment that does do very well during a deflation is bonds. Bonds do extremely well because interest rates collapse during a deflation. It may surprise you to know that in the middle 1930s, The yield on long-term Treasury bonds was 1%. 1%, as opposed to the 5% or so that the yield is today. And if the yield today were to go back to 1%, then the prices of bonds would probably increase by 200, 300, or 400%. It would be a real windfall for bonds. Another interesting fact about the 1930s and the deflation of the 1930s is that Treasury bills actually traded at a negative interest rate. In other words, people were willing to pay to own Treasury bills rather than expecting to get an interest return on them. All right, so in a deflation, you find that it's good for bonds, bad for stocks and gold, and good for cash, but not overwhelmingly so. The last category is that of recession. And I have been working with this concept of the balanced portfolio for 25 years. And during that time, I've looked for an investment that was tied directly to a recession in the way these other investments have been tied to their economic environments as we've been going over them so far in this show. I have not been able to find such an investment that profits directly from the existence of a recession. Yes, sometimes this investment or that investment does well despite the fact that there's a recession. But there is no investment that is directly tied to it so that you can count on it. So whatever your portfolio is, it is probably going to be hurt during a recession. But the good thing is that a recession is inherently self-limiting. As I said earlier, it's a period of tight money when people do not have as much money as they expected to have. And so the result is that they tighten up, they spend less, they try to sell things that they have to generate cash to replace the cash that wasn't coming in as expected. But one of two things is going to happen to keep this a short period of time. The tight money occurs because the Fed tightened up for fear that that inflation was going to get away from it. Well, the worse things get, the more the Fed gets scared from its tightening of the money supply. And usually after a year and a half at the most, the Fed will throw in the towel and start cranking up the money machine again and bring things back to what we think of as normal. And for that reason, a recession just doesn't last over a year and a half, and sometimes quite frequently, it lasts no more than a year. The second possibility is that by the end of the year, if the Fed hasn't thrown in the towel, people will become accustomed to the new level of money in circulation. Even though they don't discern what that level of money is, they just discern the effects of it, and they begin to recognize that this is the way things are, and that this is the new normal, and so they resume their spending habits, they resume their investing habits. Businesses realize that this is the way it's going to be, and that they can profit and survive in this environment, and so they start making capital investments again, and so on. And the result is that we are out of the recession within a year to a year and a half. So even though a recession is not good for any investment, it doesn't go on indefinitely. And compare that with a bull market in stocks or even a bear market in stocks. The bear market in stocks lasted from 2000 through 2002. The bull market before that lasted for several years. The bull market in gold lasted really about 10 years during the 1970s. So while bull markets and bear markets can go on seemingly indefinitely, recessions are self-limiting and they can't go on for very long. So here we have the four economic environments, and in discussing the investments that do well or do poorly in them, I have referred to four basic investments: stocks, bonds, gold, and cash. Stocks do well during a period of prosperity, do poorly during a period of inflation or deflation or recession. Bonds do well during a period of prosperity and also during a period of deflation, but do poorly during inflation or recession. Gold does well during a period of inflation, but does poorly during prosperity, deflation, or recession. Cash does well during a period of deflation. It does poorly during an inflation. It is a lost opportunity during a period of prosperity, but during a recession, having cash in the portfolio tends to soften the losses that you might be experiencing in stocks, bonds, or gold. Now, what I'm getting at here, as you may suspect, is that 4 investments give you the opportunity to be in a pretty good position no matter what economic environment is just around the corner and coming next. And what I'm going to suggest when we come back from the next break is that you have these 4 investments and have them at all times, that you don't try to outguess the market, don't try to outguess which environment is coming next, but be prepared for all of them by having all 4 investments at all times. Now, doesn't that create a situation where one investment might be doing well, but the others are doing poorly and overriding the investment that's doing well? Well, we'll talk about that when we come back. This is Harry Brown. Well, welcome back. Harry Brown here. And before we continue, let's take a phone call. We have Jen in Colorado. Good evening, Jen. Oh, pardon me. Good afternoon, Jen.
Yeah, hi.
It's good afternoon unless you're in Baghdad today.
Yeah, well, I'm in Colorado. I was wondering, I've heard several times that, probably from you, that bonds at a certain time sold for a negative interest rate?
No, Treasury bills did during the 1930s. But bonds fell down to a 1% yield.
Okay. Why would anyone be willing to accept a negative interest rate? Why not just hold on to cash?
Well, I think it was mainly because banks were considered so unsafe at the time, and Treasury securities, people know that the government can pay its principal and interest because if it has to, it can tax to get it, and it can also print the money to pay it. And so it was the safest way of holding the money, probably even safer than having it under your mattress. And so people were willing to pay a little, it was like paying a fee for somebody to store your money rather than putting it at a bank where you didn't know but what next week maybe that bank was going to fail.
All right. Okay, thank you.
You bet. I might also mention that, for those who don't know, the difference between Treasury bills, notes, and bonds is simply this. They are all obligations of the U.S. Treasury Department, the federal government. Treasury bills are debts of the government that are, when they are issued, will mature within a year, meaning the Treasury issues a bill that will be redeemed for its face value 3 months, 6 months, or a year from now. A Treasury note is a debt of the government that will be redeemed and matured and paid off sometime between 1 and 10 years from the time that the note is issued, and the bonds are debt instruments that will be redeemed, paid off, sometime between 10 years and 30 years after they are issued. And that's why they have different interest rates, because they are different types of securities, but they are all obligations of the federal government. All right. When we left off, the question was, how can you have several different investments in your portfolio at all times and expect to profit? After all, if you were to have a portfolio divided equally among stocks, bonds, gold, and cash, 25% in each, take a period of inflation. Gold would be going up, but stocks, bonds, and cash would all be losing value. So how could you possibly profit? How could you help but lose money during a period like that? Well, there's an interesting thing about investments that people rarely notice, and that is that during any broad period of time, like a bull market or a bear market or whatever, the investments that are winning have a greater impact upon your portfolio than the investments that are losing. Now, the reason for that is that when an investment is in a bear market, it goes down over a period of time, 25, 35, maybe even 40%, maybe even 50% in some rare cases. But when an investment is in a bull market, it doesn't go up 25, 35, or 40%. It goes up 100% or 200%, sometimes 300 or 400%. Far, far more than some other investment is losing. And as a result, any combination of them tends to be driven by the investment that is winning and has a bigger impact on the outcome. Let me give you a hypothetical example. It's an extreme example, but it will make the point, I think. Suppose in 1970 you had $100 and it was invested in stocks, and somebody convinced you to put $10 of the 100 in gold, and you did so. So now you have $90 in stocks and $10 in gold. During the 1970s, by the end of the decade, that $90 in stocks would now be worth maybe only $50 as a result of the terrible stock market of the 1970s. But the $10 you had in gold would now be worth about $200 because gold went up 20 times over. The result would be that you would have about $250 instead of the $100 you started with, even though you only had $10 in the winning investment and $90 in the losing investment. Now, I said this is an extreme example. It's extreme for two reasons. Number one, you wouldn't just have 10% in the winning investment and 90% in the losing if you have a balanced portfolio. Secondly, the increase in gold 20 times over was extreme, was extraordinary, was very, very unusual, and it's not the sort of thing you would expect in the future. But it does highlight what we're talking about here. And as a matter of fact, a portfolio that is invested equally in the four investments, stocks, bonds, gold, and cash, over the last 25 years has produced a return of 9% per year throughout that 25-year period. And in those 25 years, there have only been 4 years when it actually lost money, and the worst loss was in 1981 when it lost 6%. The worst year in 25 years was a 6% loss, and there were only 4 losing years altogether. Well, that music means we need to take our last break. We'll be back in just a minute with another question from a listener, and I hope you'll stay with me right through the end. This is Harry Brown. Welcome back. This is our last segment, so let me begin by thanking John Harmon for taking care of everything in the engineering booth and making sure we stayed on the air. And also, I want to thank you for listening, and I hope you'll tune in each Sunday afternoon. We have many, many things to discuss over the next few weeks, all aimed at making it possible for you to protect the money that you have worked so hard to accumulate. And I want to remind you of the Radio Links page. On that page today is a link to a mutual fund that can help you employ this strategy, plus a link to my book, Fail-Safe Investing, which explains this strategy in more detail. Plus, from last week, there is a link to the 16 Golden Rules of Financial Safety, which was the basis of last week's show. I got a question from Ed out in cyberspace. Why should one invest in mutual funds when real estate has done so well? Well, nothing does well permanently. Nothing can be counted on to do well permanently. Plus, real estate is not really an investment as we think of as an investment. You cannot call your broker and find out what your property is worth. You cannot call your broker and say, sell my property today and put the proceeds immediately into Treasury bills or gold or stocks or something else. You have to wait a long time to see what your property is worth, because you won't know what it's worth until it is actually sold, and that will take weeks and weeks and weeks. And even after it is sold, you have to wait to get your money until the escrow closes. So real estate is illiquid. Real estate is not immediately evaluated in any way whatsoever. You also cannot divide up real estate easily unless you're talking about a big tract that you're going to subdivide. But with stocks or gold or bonds, if you're find yourself over-invested because of the increase in price of the investment, you can sell off a little of it. You can sell off a few ounces of gold or a few shares of stock or whatever you want to do, but you can't sell off the front porch to a house. So what is real estate? Well, real estate is one of three things. It is either a speculation, or it is a business that people go into, but for most people it is a consumption value. You own your own home because you'd prefer to do that rather than rent, just as you would prefer to own your car rather than rent. Not necessarily because of the investment possibilities, but because of the control it gives you over the property. So I don't really think of real estate as an investment. If you want to be involved in real estate, if somebody tells you that there's something really great on the market and you should take advantage of it, then you should speculate in that with funds that you can afford to lose. But the money that is precious to you should never be put that way. We're going to continue exploring this further in the future next week. I hope you'll join me. This is Harry Brown. Thanks so much for being aboard.
Come back, sweet papa.